Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to learn how to immediately increase our cash flow. You ever been in a situation where there's not enough money and there's too much month? Well, we're going to go over that today because as you can see right here, we have negative $664.48 cents in savings, and we're freaking out. And again, let me just actually reiterate. First of all, what is velocity banking? We go over this in many videos. All it is a debt payoff strategy using a line of credit as your main tool, aka the phrase I like to use is your main operating account. Now, this is not what I call a level one strategy where if you have no money, you can apply this, right? You need to have money, and then when you have money, lenders, banks, they'll lend you money because we have to understand how banks work. They don't lend money to people who need it. And so some people are like, well, what do I do if I don't have any money? That's a different conversation. We're talking about cash flow and debt management once you do start to make some money because you know what? I get emails all the time from people who make good money, six figures, and are broke, living paycheck to paycheck because they're engaged in something called segregation of income. What is segregation of income? Your paycheck comes in, it goes to your checking or savings, and then you pay all your bills, like these credit cards 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It's split 10 different ways, actually 11 with the mortgage. And how effective is your money going to be if it's split in 11 different ways versus you parking your money, placing your money in one place and increasing our cash flow, right? That's the name of the game, increasing that cash flow with the help of a line of credit, okay? So, in order to do velocity banking, we'll go over this in every single video. We only need two things. Number one is a budget, which we have. So, income, expenses, savings. We call this the average American. And once you do you have your expenses, you list your expense breakdown. And so, every single debt that you have goes in its line item. Credit cards, mortgage, we made this simple today. And then these general expenses, we assume that these are fixed expenses, right? You remember in business school, you learned about like fixed costs and variable costs. Well, this is essentially your fixed cost that never goes away, right? It never goes away. Whereas these other costs, which is your debt, we can make them go away, and we want to make sure that they do go away, right? So that's the whole point of the strategy is to get rid of all of your debt with the help of a line of credit. So number two is you need a line of credit as your main operating account, right? Line of credit. What is it? It's a financial tool where you could borrow money, pay back, and use it over and over again. Now, a common question I get on this channel is where do you get a line of credit? And you could just do a simple Google search, right? So line of credit, and maybe your local credit union. So for example, in Atlanta, I think the biggest union is Delta Community, right? And all a credit union is it's technically quote a nonprofit bank. I don't know if it's technically nonprofit, but quote nonprofit bank. So you do a Google search like this, personal line of credit, easy access to funds. Now I used to have Delta, and then I freaked out because they told me they were going to close my account for not using it, and I just said I'm not going to deal with it anymore. And then, but I have other credit access to other credit unions, and in this country, there's over 4,000 credit unions, right? So again, people ask like, where do I get it? Google searches. There's the NCUA, National Credit Union Association. You could get it from banks, right? So banks. Do I have a credit with union line of credit with banks? Well, I have a home equity line of credit with the bank, right? So you can get a personal line of credit, home equity line of credit. They're out there, right? So, but the thing is that they're not as well known as credit cards, even though a credit card is a form of line of credit. And the reason they're not well known is because nobody's flashing commercials at you. Again, the marketing power isn't there for personal or even home equity lines of credit compared to credit cards, right? Credit cards are always shoved in your face. Remember, you watch an NBA or an NFL game, and they always have like brought to you by Mastercard, right? So now at this point, we have to make sure that we have a line of credit available for us to use, right? So we're going to assume because we're a homeowner, um, that we have something called equity, right? And banks will lend to you a line of credit with your home equity as collateral, right? And so in reality, there's no difference between a personal line of credit and a home equity line of credit. So a personal line of credit usually has higher interest rates, like 15%, and they give you lower limits like 50,000. But because you're putting your home equity as collateral, you get a lower interest rate usually and higher limits, right? Anytime you provide collateral to a lender, you get more more of the lender's resources, right? And so we're gonna assume we have a home equity line of credit. Now you might be wondering, like, if a credit card is technically a line of credit, why would we want to use a personal home equity line of credit? And to be honest, we want all of them, right? All of them have their advantages and disadvantages. But the reason why you want a home equity line of credit because it's so liquid and flexible. If I borrow like $20, right? And then the next month statement comes in. Let's say I didn't make any money, and I don't know where to get. Well, just borrow that payment from the home equity line of credit, right? So let's say the payment's $5. Okay, I'll borrow $5 from the line of credit, pay it back. Okay, payment resolved, right? Payment satisfied. They might charge me a couple cents of interest or something like that, right? So it's amazing how flexible this tool is, and you can use it to pay anything: credit cards, loans, student loans, mortgages. Where you can technically do it with a credit card, but it's so much harder, right? Using plastic, they charge that 3% fee. You may want to use plastic. Heck, I've used plastic to pay my mortgage, right? But it's not as convenient as the personal or home equity line of credit. So let's just assume we have a $200,000 home equity line of credit. And actually, let me just do this. Let me format this so that it looks a little bit better. And let me go here, currency, dollar to, there we go. There we go. And let's show the red negative numbers. And let me do this right here. So balance, uh, let's do that. Format, number, currency. There we go. And then, so if you ever wonder how do we format this to make it look spiffy, this is how we do it. We go to format cells, we go to number, and then we go to currency, and then we make it red when we are actually in the negative. Okay, so now we've done step one, step two. Now, but we haven't necessarily completed it all because we did the average American side, and look at us, we're in negative cash flow right now. And banks love us when we're here because I don't know if you knew this or not, but they last year they made $5 billion in overdraft fees. $5 billion because people are just strapped paycheck to paycheck. They got too much debt, right? They can't, not enough money, too much month, right? And so again, this is what I call the stress test because again, this is for cash flow management. When you make more money, are you be able to manage it well? And so if we have $9,000 of income and $9,644 in expenses, and most of it is debt because we went crazy and went Airbnb and traveling all over the world to find ourselves. I mean, that's a very quote millennial thing, and I think millennials are now doing things that they said they would never do. Remember how I said that? They said like I would never buy a home, and again, I'm a millennial too because I got to find myself and explore the world. Well, they probably got sick of that and decided, you know when they thought the world was going to end, that they needed a home, right? So let's go ahead and do this. Again, same income, but here's the crazy thing, right? We're not going to have any savings, right? So this is the exact opposite of personal finance or what mainstream personal finance teaches you, okay? So we're going to assume this is zero, right? And so if we go and copy these expenses, we should have the same number, but we're going to have something called cash flow. C2 minus C3, income minus expenses. And you might be saying, what is the difference here? It's the same exact number. Negative cash flow, negative savings. Aha, there is a difference because we're never going to have savings, and we can increase this number on day one just as long as we have access to a big enough line of credit. And we're going to make our line of credit as our main operating account. So what I mean by that, so some people, they look at the strategy and they say, oh my goodness, like, okay, you have an extra line of credit available to you. Whoop-de-doo. And so let's say we borrow $5,000 because we had a car emergency and the minimum payment is like $50, right? Well, if you're in this situation and you're using your checking account as your main operating account, well, guess what? Now you just have an extra $50 payment, right? And so now you're more in the hole. Whereas if you make your line of credit as your main operating account, even if you had a $5,000 whatever, right? Let's go ahead and make our line of credit as our main operating account. So what happens, what can we do to increase our cash flow and use our line of credit as our main operating account? Let's go ahead and move these 10 credit cards. So that's $167,000 of debt. Let's go ahead and do that, right? $167,000 of debt. Okay, and let's move this right here. And so what happens by simply moving this debt into here? Well, these all go to zero. The payment, zero, 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 zero. We still leave the mortgage, right? But now we went from a negative savings rate to a positive, even though we have no savings, right? This is the most mind-blowing thing about how we turn negative cash flow into positive without doing anything, except we had a line of credit as our main operating account, right? And so the actual velocity banking strategy is, once you set it up and made your line of credit as your main operating account, is that your pay or your income goes into that line of credit, and then your expenses are taken out of that line of credit, right? Because we're going to use that as our main operating account. Doesn't mean we don't use our credit cards. We can still use all 10 of our credit cards, just as long as we use it to pay, within our budget, within the $2,500 budget that we have for all of our food, gas, insurance. Because what we can do with credit cards is that we can charge them and then pay them off, but we can actually wait almost a month to pay them off, right? As long as we pay the statement balance, and then we don't have to pay interest on those credit cards, but we do still have to pay interest on the line of credit. So the credit cards are a valuable tool to help us delay paying interest, okay? So now what we do is put this in $9,000 here. It does two things. Number one, it satisfies the minimum monthly payment. And number two, it minimizes the interest, because the interest is calculating the average daily balance, right? So when you put that whole entire $9,000 paycheck, and then you delay your payments essentially by 1 month by using credit cards, you're getting the best of both worlds. That's why I have, I think, 19 credit cards and 3 lines of credit. In fact, right now I have $287,000 in lines of credit. I recently applied for a credit limit increase with Chase. They said, here's an extra $5,000 for you to use. And the reason why I applied is because I did not need the money, and banks don't lend money to people who need it. You really have to be aware of that, but most people are not. Okay, so now let's go ahead and figure out the next month's balance and the next month's interest. So to get the next month's balance, it's the previous month's balance and the previous month's interest minus this cash flow number, 14701.35. And then what do? We calculate the interest by taking the average daily balance. We get the average right here. Multiply it by the interest rate, which is 0.1, that 10%, and then you divide by 12 to get the monthly, right? And then once you have those three formulas, all you gotta do is copy and paste to figure out your debt payoff, right? And it takes us 43 months to pay off $167,000 of debt, even though originally we were at negative $600 cash flow savings, right? Overdraft fees, right? Like, this is major. You'll probably be reported check systems by the banks. If you don't know what check systems is, it's like the credit bureau for the bank. Like, if you go over overdraft fees too many times, they probably report you. But I don't know too much about it. Okay, so right, as you can see, we had immediate relief. And let's do this. Let's add an extra $5,000 to see if it changes our payoff time, right? Actually, let me do this. Did I mark down? Yeah, I mark it down. So if I add an extra $5,000, okay, how much more does it increase? Whoopsie, did I screw up? Oh, I definitely screwed up. Plus $5,000. How much more does it increase my payoff time? So let's go all the way down, all the way down, all the way down, all the way down, and it's still the same, 43 months. Isn't that amazing? So even though I had a $5,000 emergency in that month, the month I started Velocity Banking, the payoff time is exactly the same, right? Whereas if I had a $5,000 emergency in the average American way and added an extra $50 payment, oh my goodness, my life is over, right? My life is over because of that thing called segregation of income, right? And again, so all this debt is paid off, and now we just get to pay off the mortgage. And here's the thing: at this point, when you have all this cash flow, right? You're gonna this money is gonna go to your savings. Now you have two options. You can overpay your loan with your savings, this mortgage, if you want to pay it off quickly, or you can use it with the help of a line of credit, right? A lot of people on the internet argue you shouldn't use a line of credit. That's so dumb. Even though you could practically achieve the same result. But again, the line of credit helps you sleep easier at night because you pay off a piece of the mortgage, and all you got to do is dump your money into the line of credit. And not only that, it's easy. Easy has a lot of value. Because think about this: if I have to directly pay my mortgage from my savings, it's only a one-way street because loans by nature are a one-way street. You want to know why this loan is a 6% versus a credit card being 27%? Because they know they've taken away your access. That the low interest rate represents um I don't want to say low access, but what's another word to say it? Like your access to your money taken away because it's a one-way street. So kind of think of it like this. Let's say there's like a Netflix package that's like 199 a month, but you can only access Netflix from 2 a.m. to 6 a.m. and outside of those hours you can't access it. That's why loans have lower interest rates because you have only one-way access to the money, and if you overpay it, you're never going to get your money back, right? They're like, sorry, one-way street, get the F out if you ever need your money again. Unless you do a refi and you probably have to pay another 10 grand in refi costs just to be able to refi, right? So one of the things that we can do is something called chunking, which is just attacking the mortgage incrementally. So let's say that we go from 300 to 290K, okay? And then just move 10K to that line of credit. So let's say we move $10,000 here. How long is it going to take us to pay that $10,000? 1, 2, 3 months, right? Just as long as we have that cash flow. And this is also why it's important to pay off debt in the correct order. And I was talking about how in other videos, we always pay off the mortgage last. And the cash flow index is a tool that can help you understand why you pay off that mortgage last. But let's just take a look here. So loan amortization calculator, about how this all works with an amortized loan. So if I have a $300,000 loan for 30 years at 6%, okay, and again, we paid off $10,000 in about 4 months. 1, 2, 3, red again, four, right? How long is it going to take you to go from 300 to 290? You could see it takes us about 1 year, 2 year, probably 2.5, right? And look at all this interest you pay compared to the actual principal. And principal means that you're actually attacking the loan balance, whereas the interest is the bank's profit, right? I'm sorry, let's go ahead and take a look at the monthly schedule. And let's zoom this in too so you can all see, right? So here, how long did it go to take us to go from 300 to 290? It's going to take us 1 year, 2 year, 2 years, and 1, 2, 3, 4, 5 months, right? Whereas we did it in 4 months, right? 4 months, 1, 2, 3, 4, and it was so easy. And then you just rinse and repeat over and over again. Oh my goodness, that's basically how we would pay off a mortgage. And again, one of the most important things we have to consider is that the mortgage is paid last, right? It's paid last. But yeah, that's how we immediately increase our cash flow. Look how easy that was. And again, if you might be thinking like, hey, I don't make enough money. Guess what? I learned this for 3 years without ever being able to apply because I used to make 23 grand a year. And so once I made some money and got some debt, I was like, poof, 25% of my mortgage is gone in 1 year. And then, under 3 years, 2 years, and 9 months, poof, mortgage is gone. And again, I'm going to flex a little bit. I'll probably get sick of flexing after a couple more videos, but I should flex while I still feel like bragging a little bit. Okay, well, that's it for today. Have a great day, Crane Atlanta Mentorship. And again, I will have that Google form open soon once I get off my lazy BUTT, right? So that's it for today. Have a good night, and we'll speak soon.